Okay, let's call the meeting to order and take attendance. I'm Leah Hayes, the police trustee.
I'm Walt Mary, a member.
Oh, Steve Arbell, member.
Harvey Lewis, member.
Ross Johnson, U.S. property account.
Greg Pittenger with Principal Asset Management.
Greg Williams, staff.
William Johnston, staff.
And do we want everybody online?
Oh, yeah, I'm sorry. Cole, go ahead.
Yep, Cole Jacobs, WTW.
And
Zach Parents, WTW.
And Peter Damaris, City Auditor's Office.
thank you.
Okay, thank you guys. Do we need to adopt the agenda or make some changes?
You need to adopt the agenda modified. The board attorney won't be available until about 9:45, and he will be calling in at that point. So I think we just move the principal presentation up, and after the approval of the minutes, and then once they're done, we'll see what time it is and decide whether we have Willis Towers Watson give their presentation or whether Bob's available.
Okay. Is there a motion to adopt the agenda as William made the changes?
I'll make that
and-
motion.
Second.
All in favor?
All right.
All right. And the minutes from last month's meeting? Is there a motion to approve?
I'll move that.
Second.
All right, all in favor?
Aye.
Okay, we can move on with the first item of business, which is the presentation by principal. Ross, go ahead.
Excellent. Thank you all for the time. So just to confirm, William, about 20 minutes presentation and 10 minutes questions, does that
Sounds good.
work? Excellent. Thank you all for the time today.
I will let you know that I do not get mad at it if it's shorter.
Got it. Fair enough. Yeah, please.
Good feedback.
No, we'll keep this short and sweet. So hopefully you all have the presentation in front of you. My name is Greg Pittenger, again, Principal Asset Management. I serve as your client advisor based in Raleigh, North Carolina, and work with institutional investors like yourselves throughout the Southeast, bringing the resources of Principal Asset Management. Fortunately today we have our real estate team in front of you. Ross Johnson, my colleague, who focuses on your portfolio, the U.S. property account and the core real estate function. We'll let him talk a little bit more about his experience, but with the portfolio management team, so fortunate to have that today. I will focus on page 4 real quick and just give you kind of an overview of Principal Real Estate, any changes since the last time we met. Again, top 10 global real estate manager on the left side there gives you some ideas. We're still growing. Things have been solid over the last couple of years with COVID. We'll focus today on our 4 quadrants here on the right side. We manage just under $100 billion across the real estate platform, but today we're going to focus on that top left kind of royal blue quadrant, the core private equity. You'll see it's the lion's share of our assets under management. Most of our clients are in that space, about $50 billion of assets under management in that area. Obviously, it gets the resources needed. On the left side, I'd point out real quickly, we have over 600 clients from 34 different countries, total of 300 real estate professionals across the franchise, and a long tenured team with an average of 13 years experience with the firm. So I've been through multiple cycles and seen both the good and the bad. So with that, the one thing I would focus on briefly here is the 4 quadrants. What I think this brings to the table for you all as a benefit and differentiator, the principal does, is we have access to Ross's team has access to both the private side as well as the public side in real estate. So you see the bottom left there in the public REITs and infrastructure, and then on the right side, obviously more pertinent of late, the private debt and public debt markets across the real estate space. So that's obviously an area that's had a lot of volatility of late, and this gives Ross's team and you as our clients some deeper insight into what's happening. I think that's unique in the asset management space, that one firm has access to each of those areas and can kind of share what's happening in real time with things like right now in the marketplace, and what kind of debt deals that Ross's team thinks can happen or can't happen, and how to, if we want to sell a property or purchase a property, what are realistic terms in real time. So with that, if there's any questions on the actual real estate platform, I'm happy to answer it. If not, we'll get into the portfolio and talk a little more on that front.
Perfect.
Thanks.
Yeah, if we actually flip to slide 6 of the presentation, as Greg mentioned, I'm Ross Johnson. I'm portfolio analyst for the Principal U.S. property account. I've been with Principal for 11 years now. Prior to my role in the account, I was on our private debt side of the 4 quadrants Greg talked about. Most recently in our private debt origination group, originating loans in the Midwest markets. The rest of our team is largely unchanged. You see here on the chart, should be familiar. Darren and Megan are the co-portfolio years. Megan's been with the team or the account since 2006. Darren joined the account in 2007, Bridget in 2013, myself in 2018, and Ellen in 2021. So a pretty long-standing team that's managed the account through multiple cycles there. On slide 7, we just kind of provided an overview of the summary of your guys' fund within the account, so can answer any questions there. But if we flip to slide 8, we provided some key stats just for the account as of the end of the year. Most of these we'll touch on in more detail later in the presentation. Gross assets of the portfolio were over $13.3 billion ending the year, and the net asset value at about $9.8 billion. I do want to touch on kind of the last 2 bullets that are on the slide. The contribution queue balance ended the year at about $566 million. Of that, we have one very large investor that's in the queue for $500 million, so they're taking up that lion's share of the queue there. That client's been in communication with us. They still are very interested in investing in the account and have asked us to really advise them on what the right entry point is. Given the volatility, we'll talk about later on performance, just when the right time is based on some downward pressures just on overall valuations. And that's been consistent with how we've talked to new clients in the market today. We think that it's a great time to invest. Start doing your due diligence. It will be a great time to invest in more core opportunities going forward as the environment's changed. So it's a good time to get your due diligence and your documentation in line, and then be ready to kind of seize that opportunity when it comes.
Can I ask you a quick question?
Yeah.
The large client that's got the $500 million withdrawal in the queue, can you tell us what their overall investment is?
That's actually a new client to get into the queue.
Oh, it's
Yeah,
it's a
yeah,
contribution.
Yep.
All right. It's contribution. Never mind.
No,
Sorry.
you're fine. And then second there, we have our withdrawal limitation still in effect. Just as a reminder, over the 40-year history of the account, we've only had a withdrawal or redemption queue 3 times. The GFC was the first one, COVID being the second one, and then most recently in the third quarter of last year, just given the denominator effect as the equity markets changed rapidly. So we ended the year at about $815 million in that redemption queue. Year to date, that's grown to a little over $1 billion. So that's about just under 11% of the overall NAV of the account. On a relative basis, if you look at our benchmark at the end of the third quarter, their aggregate redemption requests across all managers was about $23 billion. Fast forward to the end of the year, that had grown to $32 billion in aggregate, so big increase across all managers there. And that was a little over 12%, so on a relative basis, we fared pretty well as far as our redemption requests go relative to kind of the average. As we look forward, it's likely we're going to continue to have both a contribution queue and a withdrawal queue in place just until we get a little more clarity surrounding the overall economy. The bank failures of recent is not helping that outlook for sure. I think as our team, when we flipped the calendar in January, we felt a lot better about the outlook. That sentiment has probably changed recently, so we'll continue to evaluate that as well as just commercial real estate valuations. Like I said, we still believe in core, the long-term fundamentals there, but believe there's some short-term downward pressure there, so continue to monitor that. Any questions on slide 8 there? Perfect. Slide 9, we've laid out our strategic themes and how we look at investing for the portfolio. So on the left-hand portion of the slide in that blue font, those are kind of our high-level strategic themes. Those don't really change over time. Serve as kind of the framework for what we look at, how we invest. As the market changes and evolves, those sub-points really change with the market. So about 12 months ago, you would have heard us talking more about disciplined capital deployment, how we look at buying new deals in the pipeline. That's changed to more of a defensive posture, just given potential outlook for a recession in the near term. Prudent liability management has always been a focus for us. It will continue to be. It's probably heightened as interest rates have increased and the potential for debt capital pricing has changed recently. So that's a continued focus for the account. And then finally, driving operations. So really at the property level, optimizing property operations and growing income. That's one of the best tools we have to offset any value impacts. As things change rapidly, the more we can grow income and control that piece, we can offset those impacts. And then on slide 10, I think this is a good visual for how our investment decisions have really materialized both regionally and at the market level. So within those bubbles, the size of the bubble is how much we've invested within that given market, kind of on a dollar basis. And then the color of the bubble just represents whether we're overweight or underweight relative to the benchmark within those markets. Our team works very closely with our in-house real estate research group in identifying the long-term markets with long-term growth drivers there, and they've developed a framework they've labeled as the digital framework for identifying those markets, and that's really just focused on demographic trends, innovation, technology, and growth to identify those markets, and that collaboration with the research team has really shaped what you see here on the slide. So being overweight to the west regions and the south regions has been a relative outperformance given the migration trends we've seen, particularly since COVID. Those regions have materially outperformed areas like the Midwest and the East Coast over the most recent time periods. Then please feel free to jump in with any questions at all. Over the next four.
You got a question?
It's not really, well, yeah, I guess it's a question. It's a comment that I guess should be a question. We hear a lot in the media generically about people moving away from office, working from home, not the demand for office space being diminished. Again, generic, not sure what it looks like specifically. What impact, if any, has it had on your investment or the portfolio or your future that you see in the market?
Do you want to touch on that in the
Yeah.
office?
Yeah, if you don't, we have some comments in a couple slides on the office sector that we'll touch on that if that
That's
works for you.
perfect, that's fine.
Yeah, great. Yeah, so the next four slides, we've just highlighted the high-level sector slides with our allocation relative to benchmark and just how we're looking at each of those strategies. So if we start with industrial, we finished the year slightly overweight the benchmark at 32% allocated to the sector. Overall, we've focused on maintaining an overweight to kind of what we've identified as major distribution hubs relative to the benchmark there, and we'll remain focused in kind of that warehouse and distribution style product type there. And then we've really focused internally on owning the right product in the market, and what that means is we partnered with our production staff, which is our acquisition group, and our asset managers to really help us identify within each market that we want to be in, where's the most deep tenant demand? Is that users that are 500,000 square feet users, or are the users that are 50,000 square feet, and really tailoring to target buildings that are appropriate for them, just to have that long-term pricing power. As we go forward, we'll look to maintain that overweight within the industrial sector and continue to focus on those strategy points I talked about. If we move to residential here on slide 12, this is the highest conviction strategy our team has across the sectors, and that's really evidenced by our strong overweighting relative to the benchmark at the end of the year. We focus across all of our investments on buying differentiated product in the markets, but and that's no different in residential, but what we've added to that is really focusing on a diversified tenant base within the residential sector. So what I mean by that is kind of highlighted by the pie chart down below. So we have exposure to affordable or workforce style product in the portfolio. We also have Class A, or what we call renter by choice category. And then we've also gone further and diversified it into student housing, age-restricted communities, and most recently into manufactured housing and single-family rental portfolio. And we'll look to continue growth within kind of those newer sectors, single-family and the manufactured housing space. But overall, we feel pretty strong about the outlook in residential, and we'll continue to maintain that overweight there. And then moving into slide 13, office. As you touched on, this sector remains certainly the most challenged sector in the space, given the headwinds of COVID and the whole work from home. So we ended the quarter at 21%, so slightly underweight the benchmark. And if you look back, we actually peaked with an office allocation of 47% in 2015, so we've done some significant work to get down to this underweighting. That was a little over $2.5 billion of deals that we sold over that time period.
That was a deliberate decision on your part?
Yeah,
going on
Absolutely.
for several years.
Yeah, so we started seeing a trend, and this is prior to my team, so benefit to the team of noticing as we looked at new deals in the market, the rents had moderated or grown slightly, but what it cost to put a tenant in a building had risen exponentially. So that value proposition had changed over time, and that was kind of a signal to the team to start reducing that office exposure. And we had the benefit coming out of COVID of building some large Class A office too, so that built up that allocation. We did very well on those, but certainly feeling a lot better about where we're at on a weighting wise today, given the headwinds, and we'll look to continue to sell where possible. The deal here on the slide is actually a good example of that, 601 New Jersey and Washington, D.C. We have two larger office buildings in D.C. When we were 47% office, it made sense to have two larger buildings in the market. As we've right-sized the office portfolio, it makes probably less sense to have both of these. So we'll look to right-size the market there. Both of these deals we've recently signed an expansion and extension of a tenant, the largest tenant in the building, so they're 98 and 100% leased in the market today. On a relative basis, we think there's liquidity for these buildings in the market. So we'll look to potentially market one of these two towards the second half of the year.
I think one other point that Ross is hitting on here that you asked about, where was liquidity, some of the market space here, the growth markets, as you see, we focused on that royal blue piece on the pie charts. We're at 40% versus the index at 18%. And the way we identify these kind of growth markets are, you see Austin, Cambridge, Denver, Phoenix, Seattle. So some areas where there are folks going, there's growth versus, large core markets in the past where your gateway markets, considered Boston, Chicago, Los Angeles, New York, where you've had major metro transportation, and during COVID, there was a very dearth of office interest. So that's a big differentiator.
Absolutely. Yeah, I was touching on that for sure.
Yeah, when COVID hit, a lot of deals were made extending leases. Is any of them starting to come due now? There are 3 5-year deals?
Some have. We haven't seen a whole lot of them. We've had the benefit of having longer term leases at the time. Where we've seen some demand, particularly in New York, and kind of this is where our portfolio differs from the rest of the benchmark, is the office space we have there is relatively smaller floor plates, so 15,000 square feet relative to a 25 or 30,000. So the demand in the space has been pretty strong for that size, where a law firm can come in and take a whole floor and have that kind of cachet of you can come in and get off the elevator and we have the whole floor. So that's been a benefit for us a little bit in the portfolio to have that smaller building, but that's been a change since COVID, so hopefully that continues there. But certainly still headwinds. We'll talk more just on how we've written these office assets down relative to the benchmark here in a couple slides too. And then finally, retail. We're equal weight the index for retail at 10% ending the year. Overall, how we built our retail portfolio differs greatly from that of the benchmark. So the pie charts here at the bottom, you'll notice we're almost 80% of our retail allocation is in neighborhood or community centers. And you can really think of those as necessity-based retail or grocery-anchored centers. And then you contrast that with the benchmark of only 33% within that asset type, and that product type generally performs very well across all cycles, and certainly in downturns as people still need to get out and go to the grocery store, etc.
And focus on like grocery anchored, tenants like the best in markets, so Publix down here in Florida or Harris Teeter in North Carolina, that kind of thing. Yeah, exactly. So that's where we're focusing resources.
Yep. Another thing to point, we have no malls in the account. We have never owned a mall. We do not plan to have a mall in the future. The benchmark has about a little over 30% within malls within their allocation.
You can get them cheap now.
Yeah, the problem is the ticket. It's still a big ticket item. But yeah, it's not
cheap.
something we're
It's just
spending.
nobody wants it.
Yeah, what are you going to do with it? That's the
That's
other.
the opportunity to repurpose and recycle.
Correct.
Yeah.
Getting it, yeah.
When you get an eye exam here, you gotta go to the old mall.
Yeah,
Yeah, well,
somebody will try it for sure.
you have to let off the tax rolls.
But overall, our retail portfolio, we've seen very strong fundamentals across the portfolio. A good example of that was in Fort Lauderdale. We actually had a grocery tenant leave, and we had 4 grocers come to us wanting that space, so we were able to backfill it and really utilize or getting the best terms on that space, and we're going to lease with Aldi at that property. So just a good example of where we're seeing demand within the space, and that's changed since COVID, where retail was really hit really hard. And then on page 15, this is a newer slide we've kind of added to our materials as the alternative property sectors or the niche property types have really grown in favor over the last few years. Within how the property sectors are defined currently in the benchmark, it's hard to tell where we've been allocated to those. So what we've done here is just pulled those out of those 4 larger sectors where they're normally housed and kind of provided their own little bucket here. So we ended the year at 11% allocation to those alternative sectors. And we've had a long-standing commitment to this space, and we've been invested in spaces like student housing, age-restricted multifamily, life science, and data centers. And then most recently, we've added to that with the manufactured housing, single-family rental, and self-storage. And we'll look to continue to grow that allocation going forward, particularly in some of those newer property types where we have some very compelling strategic JV partnerships there. Slide 16, it's just the top 10 properties for the account as of the end of the year. Just in the interest of time, we'll probably not spend too much time here, but happy to answer any questions. And we've talked a lot on just the asset side of the balance sheet. As I mentioned earlier, we're very focused on the liability side of our balance sheet too. And on slide 17, we've provided kind of our leverage forecast. And how we look at leverage in the account is generally trying to match the asset and liability based on the property's business plan.
Sorry about that.
Oh, you're fine. In general, that's meant long-term fixed rate borrowings for core portfolios or deals that we look to hold over the long term, and then shorter term floating rate debt for value add or development deals. We're also very focused on relative value on the debt side of the balance sheet. So as a core fund, we utilize a low level of leverage. We ended the year at 24% leverage ratio. So what that means is we have the ability to be very flexible in how we put leverage in the account. And we have an in-house capital markets team that sources debt for all of our portfolios, so they're very in tune with a bunch of lenders across the market and getting data points for us. And they've been able to help us identify the cheapest cost of capital and where that lies, whether that's putting debt at the property level. So if we buy an industrial building, leveraging that, or we can also go about getting portfolio level debt, and those markets have diverged at points in the past, and we've been able to capitalize on those time periods.
I think goes back to that 4-quadrant piece where Ross's team has some real insight into the debt side, because our team transacts on both sides of the balance sheet, as you mentioned.
Yeah, and then in the middle of this chart, we just highlighted our debt maturity schedule, and then our team's focused on maintaining diversity across this schedule. In 2023, you'll notice we do have an elevated number here. One of those loans we've already paid off for the year, and much of the remainder of that are floating rate deals on development projects that we've recently completed and stabilized. So we have the opportunity now to kind of evaluate the leverage strategy on that building and say, do we want to go out to the market and look at a more core, longer-term debt for the asset, or potentially paying that down, given where we've seen volatility of just debt pricing in the market today. Certainly the bank failures are not going to help that. It's likely you're going to see us be, on a net basis, probably paying down some debt in 2023. Debt is just in the short term, if values still have pressures on them, it's just not as accretive to total performance. So it's likely we'll use some cash to pay that down throughout the year. But we'll continue to evaluate pricing with the teams we mentioned before. And then just quickly at the bottom here, we've outlined some just key debt metrics. Having about 77% of our debt in fixed rate has been really beneficial for the portfolio, particularly as rates have risen. Having that cheap cost of capital locked in has been a benefit for sure. And then finished the quarter at 3.92% of just weighted average cost of debt capital across the total portfolio for the year. And on a relative basis, that's about 25 basis points lower than our peer group. So kind of goes back to being able to source that data from the capital markets team and getting the best execution. So slide 18, we've just provided our nominal total return performance of the account. I think if we actually turn to slide 19, I think it's the same data here, it's just relative to the benchmark, which I think is a little more informative for the group, certainly. So within the bar charts in the royal blue, it shows the account's gross total return performance over the time periods. And then we've shown that relative to both measures of the benchmark there. So you're going to notice the short-term underperformance across kind of those short-term periods. It's not something we're used to having to go to clients and report. It's not something we're frankly comfortable with, but as we look at performance across the benchmark, it's been widely disparate and the volatility has been the widest we've ever seen. Just as an example, ending the year of 2022, there was 1,900 basis points, 19% difference between the best performing manager and the worst performing manager. The best performing manager reporting a little over 16% total return for the year, and the worst performing being at that a little over -2% for the year. So as managers have looked at impounding all these valuations, there's a very wide range of how people are looking at that today. We certainly don't think having a 16% return in 2022 is right by any means, given the volatility.
Do you attribute that to, valuations being inaccurate, or?
We've heard a lot of anecdotal information as we've talked to clients and consultants as how others have looked at it. We've been far more proactive in how we've approached that, utilizing our acquisition teams as they've seen other deals and buyers and how they're looking at it. Not only that, but then what does the debt look like if you buy a deal and that cost of that debt is so much higher today? Right. So we've impounded that. We've heard others out there that are focused more on just what the appraisers are giving them, and that given transaction volume in the fourth quarter of 22 relative to fourth quarter of 21 was down 75%. The appraisers had no data points to really look at. So we've heard some purely relying on that kind of lagged appraisal data and just saying, show me the comps. So that's not the approach we've chosen to take.
Said you wanted an appraisal, they gave you an appraisal.
Yeah, I mean, that's where, to Ross's point, we'd much rather be conservative and proactive on your behalf.
Absolutely, having the right values. And that all goes back to being able to call capital or pay out of the queue. Once we can get those values right, that's when we feel like we can make those adjustments. And I think we talked about office earlier, a good example of that. We've written down our office portfolio since COVID started by about 23%. The index is only down 10%. And that gets even more exacerbated in markets like New York or San Francisco. So we think there's a lot of catching up potentially to do from our peers within the benchmark, certainly.
And that's traditionally where we've seen in downturn markets where we've been more proactive in writing some of this down. You're going to see the catch up over time of our peers. And we feel like, it's unfortunate to see that. But as you can see in the long-term returns, that's where over a long period, this team has shown that they're investing in the right areas in the marketplace and focusing on the right long-term fundamentals rather than a short-term valuation from a third-party appraiser that's maybe a little stale.
Yeah.
It is complex.
And then I think just quickly on that same slide at the bottom, we've shown our income return over those same time periods, and the accounts outperform pretty materially relative to the benchmark down here. And I mention that just because we think going forward, the income component of total return is going to be the largest kind of component of that total return. Historically, that's been the appreciation component. That's certainly going to flip going forward. So we think we have the ability to maintain that outperformance, and we have some opportunities to continue to grow income in the portfolio. And that kind of leads me to slide 20, which is our same property net operating income growth. So on the left-hand portion of the slide in the gray bars, that's just been our actual performance over time, over the last 10 calendar years, where we've had strong, just nominal performance in the account. But when you look at it relative to the benchmark, we've outperformed by nearly 2 times over that time period. And then in 2022, we actually recorded our largest year-over-year income growth for the portfolio in its history since we've been tracking that metric at 15.5%. And then in kind of that blue box over the right, we provided our income forecast through 2025. So if we look at 23, that 2% growth is a function of a couple things. One being how strong a performance we had in 2022, and we pulled forward, had a lot of NOI growth. It's very hard to incrementally grow off of a year like that. but it's also reflective of kind of impounding our internal house view of a larger probability of a recession starting to take hold in 2023. So you saw us mute some rent growth, really push out any speculative leasing pretty far out within our cash flows. We don't think it's prudent to have that starting to really hit our cash flow in 2023. In 24 and 25, you'll see growth ramping up there. We think we have a very strong opportunity, particularly in the industrial sector today, to grow income, and that's kind of organically built into the portfolio today, where the average contract or in-place rent for a tenant within that portfolio today is about 25% below what the prevailing market rent is today. So as tenants roll, it's generally not a good thing when tenants are rolling. We think we actually have an opportunity to really grow income as that rollover happens, just given the strength in the industrial space today.
Yeah, limited space in the markets we want to be in. So
Yes,
And
absolutely.
you see a big turnaround in office too, obviously.
Yeah, so in the office space, it's taking up a large portion of that contribution. We have been very prudent about what the speculative lease up is in our portfolio. So we've actually, on average, we're looking at 36 to almost 5 years and sometimes longer in how we've leased up our vacancies in the office portfolio. The reason you're seeing it show up in such a large contribution here is the office rents just generally are the largest rents on a per square foot basis just in the industry. So if you have a vacant space that's actually a detractor to income at the portfolio because you have to keep the lights on and everything if the tenant's not there, just even incrementally leasing a little bit of space provides a huge benefit as a total dollar contribution here. So even though it's a huge portion of this here, it's not like we're leasing up all of our office to 100% by the end of 2025. We've taken a measured approach to that, but it is a huge benefit in an area if we can hit these targets, provide some significant growth for the portfolio. And then quickly on the next slide, we've taken the same data as what we just talked about. We've just kind of spliced it a little differently, more on a dollar growth basis. With 35% cumulative growth through 2025. And then on the right side of the page, we've just highlighted where that growth is coming from. So how much of it is coming from the operating or the core side of the portfolio, and then how much is coming from deals that we've developed or are in lease up. So good diversity between those two, but still a very large portion coming from that core property set. And then the last page is really just a summary of some of the key points we've already touched on today, but want to make sure to leave some time for any questions you all might have.
I think California's going to hold up.
That's a tough one. Yeah, California is certainly not helping us with some of the regulation changes there too. Particularly, I don't know if you read about the mansion tax that they had established. So we've impounded that in our valuations already today there. Where we have the biggest exposure is apartments in Los Angeles. We still think there's a structural imbalance and a need for housing there. So I think that's a benefit. And then we're also overweight to the Inland Empire, or like the Orange County industrial area. And that, given the port there, that's seen tremendous growth in income. And we've seen, as leases roll over there, we've seen 60% growth in what the tenant was paying to what the tenant will now willing to pay. Our asset manager actually told us a couple quarters ago that he had an auction he held for demand in the space, and he's never in his whole career ever had that ability to do, where he went back to everyone and just said, keep giving me your best and final. So the growth there has been pretty incredible. Now, when you look at San Francisco or Oakland, those are certainly areas of concern for us, particularly. But yeah, it's something we're watching, certainly.
Well, I think maybe you were answering the question I was going to ask. I'm not absolutely sure, but given what you said about the difficulty of financing new housing and the overwhelming demand for affordable housing, that is to say, rates that you can't make money on, where do you see that market going? And how is it going? How are we going to house people who need housing and at the same time protect the investment that we make for example?
Yeah, I think given our overweight today, that we're in a good spot, given the dynamics of what it costs for somebody to go out and buy a home. Now that's changed as mortgage rates have changed, so we're going to see an increased demand for rentals as people who are potentially looking at saving up to buy a home. That budget has changed dramatically. I think I saw a stat the other day that, if you had a $600,000 home at a mortgage rate of around 3%, that budget only gets you a home of $380,000. So it's a material change there. So we think people will continue to push out that decision to potentially be buying new homes. And that's kind of where we see that opportunity within the residential sector. And we think that bodes well for demand and growing income there as people are pushing that. Does that answer your question?
Well, it does, except that the people I'm describing aren't anywhere close to being in the investment market. I mean, these are people who
Workforce here, yeah.
who were working for.
Blue collar, yeah.
Oh, right, yeah.
And I don't mean by that, I don't mean poverty strict, I mean working poor.
Sure.
The people we rely upon to make the machinery of government work, for example.
Yeah.
That is so overblown, Paul.
Well, okay,
And our
so you're
people
making
are
$35,000 a year, $40,000 a year.
Yeah, and it's and you have this general
Stay
belief
home.
that every one of our employees
No.
is a single income family. Come on.
All right, let's modify it then. Let's say if you have everybody has two incomes in a happily nuclear family. So that raises your threshold to 70,000.
So wouldn't fixed income
Just
be the
wait,
key
just wait.
there?
It's okay for reasonable people to
No,
disagree.
But I don't see that
The
as
general narrative from folks of your ilk is that there's only one income in every household in this community, and it's just not true.
I just don't think there's the level of the 35,000 level I used. I don't think a large portion of our community makes that amount.
Not being rent at 35,000 level.
Anyway,
This organization, yes, they do. They make
Perhaps.
more than that.
Yeah,
Oh, Jesus,
yeah, yeah,
perhaps.
no.
Who do you
I-
think knows more about that, me or you?
You, and I'll concede that.
Okay, good.
But
I'm sorry.
Generic.
I appreciate your point of view, Walt.
But
Even
well,
if it's
of
wrong.
course, but but generically, there's a vast market out there of people who, and they're not necessarily in Gainesville. They may be on either coast or in Texas. There's a lot of people who are unhoused or marginally housed
Yep.
that need housing, can't afford it.
Yeah, it's certainly an issue, and I think within the portfolio and how we focus kind of on that workforce housing or affordable component, it kind of goes two ways. We have deals in New York where it's mandated that we have a certain portion of the property that's affordable, and that's mandated by the state coming in and saying, based on different bands of the median income level, you have to have a certain amount of units available for that. So the rent level is kind of predetermined. It's kind of bond-like. There's a huge waiting list for those there. So the state comes in and they said, what's the appropriate level you can charge for those components there? And then the other workforce, we partnered with a group called CAPREIT, and they really focus on finding that workforce housing that's still affordable, still finding that monthly rent check of, depending on the market, $1,800 to $2,300, and making sure we still have to do the income checks, still income verified, but coming into a property that's been run down, putting in some money to it, and providing housing for those people that have updated appliances, updated flooring, paint, and everything, so they have a better experience there. And we've actually bode very well there. But as far as targeting people with incomes that can't afford it, that's not where we've
Yeah, I know that's
space. But it's certainly something that
Yeah.
somebody much smarter than me is going to have to target.
Remind the board that our goal here is to make returns for the plan.
For the plan.
And Walt's not arguing that we shouldn't make returns and we should become a social service fund. I didn't hear that at one point at all. My general belief is that folks are just going to have to change the bar on what portion of your household income should be used for housing.
Yeah.
You know, this antiquated 30% doesn't apply with what housing costs today. Yeah.
And it's a triple whammy between inflation and interest rates.
Yeah.
And even like, take this city for example, a lot of people commute, and gas stays high. Their income's down, so too.
Pick your poison.
Yeah.
We actually have a project coming out of the ground, I think you're in Gainesville, a few blocks away, with workforce housing mandated at some percent.
Is that right?
It'd be interesting to see how that plays out.
And there will be more of that likely with city centers where it's difficult to have affordable housing. So
So
we're
we're
going to see
10%
more of that.
affordable housing.
Sure.
Yeah, we've seen it.
Yeah.
Yeah. But we also have money available to help with the but-for gap, because of the largesse of the federal government. It's not, since it's not our taxpayers' money, it's nobody's taxpayers.
Fair enough.
So,
Fair
but,
enough, yes.
but yeah.
Okay.
And I don't think we're unique in folks leveraging local funds with those type of mandates, so.
That-
No.
Yeah, you're seeing that
We've
across
seen
the
that.
country.
Yeah, a
Yeah.
lot of places provide if you want to come out of the ground with a new project, it's 10 to 20%, and you're not getting a tax subsidy to do it. It's just, you got to bake that into the budget. And the flip side of that is that actually hurts new supply and getting new supply to the market, because the returns don't make as much sense when you start doing that. So it's a little double-edged sword a bit there, but yeah, it's certainly something we've seen.
Yeah, if the market says you're going to earn interest rates of 3%, that makes your job quite a
Absolutely.
bit
Right.
different.
Yep.
So if the market says, well, you can get 7 by just sitting on your hands,
In this marketplace, yeah, definitely.
that's what William thinks, well, let's sit on your hands. No, I'm kidding.
Are there any other questions that we could help with?
Thank you, that was helpful.
Thank you all for your time. We really
Great
appreciate it.
meeting. Yeah.
Yeah, if you have any questions, you know to get a hold of us, and thank you all for the time again today. We really appreciate it.
Nice report, thank you. Caused me to sneeze.
Well, now we got some
High values.
big cracks.
About by me,
I forgot about newspapers.
they took 39 to the
Oh, it did?
I suspect it's going to be single family.
All right, next on the agenda, we have the waiver request from Disciplined Growth Investors.
And I didn't
Wanna
know
try Bob?
if Willis Towers Watson wanted to comment on that or not. You know, Fred was here, or not Fred, but DGI was here at the last meeting and discussed this. There were some minor corrections to the plan referenced in the document, but nothing else has really changed. And Cole, I think, you know, between discussions that you had with DGI and that staff had, you're more or less comfortable with this?
Yeah, I think as it relates to the first one with concentration, increasing the market value to 12%, no issue there, you know, as far as single security is concerned. You know, ultimately, this is definitely up to the board, but as it relates to the second piece of the sector weighting, you know, none of the portfolio sectors shall exceed 66% of the portfolio, and one of those sectors is essentially technology. So you could consider approving one and not approving the other, or you could approve both. It's ultimately up to the board, but I guess I would just somewhat caution the second piece, as information technology could be a definite return, predominant return driver of the portfolio.
And, you know, just to add one thing to that, I mean, I agree with Cole about, you know, the caution of over allocation to information technology, which, you know, that's sort of been a typical theme at DGI for a long time. In speaking to them about, you know, there are no guarantees, but in speaking to them about the desire to increase these super sectors, I guess they called them, their focus was really more on energy, because there are some energy companies that they're interested in, and it's such a small part of the benchmark sorry, this is going to be Bob calling in.
That's BOB.
So, hold on just a second. Bob?
Hey, how you doing?
Good, good. We're in the middle of one item, but if you hold on just a second, we'll be done in a minute.
That's fine.
Okay.
Put the timer here.
So.
He's a minute early.
So they really wanted to be able to hold slightly more in the energy sector than the benchmark. But by more, I forget the exact numbers, the benchmark was like 3%, but they wanted to hold up to 4 or 5 or 6 or 7% in energy. Now, having said that, they've expanded, they've used these super sectors to, expand really the ability to hold much higher weightings across multiple sectors. So I still agree with Cole that there's caution, but the original intent, according to DGI, was really focused on the energy sector.
And that's beyond just oil and gas.
It was oil and gas.
It was oil and gas. And now it's wind power, solar power.
Well, I mean, they were interested in some oil and gas companies, some
Sorry,
US-based
I got you.
companies.
Is this something that we need to vote on?
Yeah, you would need to vote to either accept one or both of these, or not accept them at all.
Well, I'd say like in 23 years or 26 years, however long we've been associated with them, they've returned over 10%.
Yeah, we've been
So
fairly happy
I'm
with
inclined to
their.
kind of give them their
Yeah.
reins.
Actually, I agree with Barbie. You need a motion?
Need a motion
Yeah,
and a vote.
Discussion?
They've been in the portfolio since '97, and they've returned 10.7% annualized since then. So, yeah, very, very strong returns over a long time period.
Yeah. Well, I'll move that we accept that, the amendments or the modifications.
Second.
All right, all in favor?
Aye. Thank you. Bob, you're up if you like.
Yes, I looked at the changes that were made to the policy about terminated vesteds. I'm fine with the changes, and I would recommend adoption.
Whenever it's new language, really. I'll also move, yeah.
The two unreasonable people like Bob and can agree on minor changes like that. How can I not second that motion?
Is there a motion to accept?
Yeah.
And seconded by Steve. All in favor?
All right.
Aye.
All right, motion carries.
The only other thing that I had was, I'm keeping an eye on House Bill 3, which is what's been described as the anti-ESG bill. The only thing that I would look at now is I've tried to get an idea from WTW on what, if anything, in our portfolio would have to be divested if that bill is adopted, and what the economic impact would be on returns, because that's going to be reflected in the city contribution. They have not, I haven't seen a fiscal note on this bill, and the fiscal note to the state, other states have put out notices already. Kansas said statewide it would have a $7 billion negative impact. Some other states have had similar impacts. There is an identical bill that's pending in Texas right now that I'm actually on the way to the airport to go to, I'm in Georgia, but I'm on my way to go to Texas to address that issue. Boards should never be involved in politics with regard to their investments. You invest for the highest and best return with a reasonable rate of risk. Everything else, in my view, is noise. But if you're going to be required to specifically avoid certain things, then it could have an impact on the cost. The bill is going to get adopted in some form, like most bills that end up in Tallahassee, it will get amended. So we're going to continue to keep an eye on it. When it gets to the floor and we see what it's going to look like, then we'll be doing an informational memo that will be distributed on what we think you will or won't have to do. that would be something which would be prohibited by this law. You have to explain why you did that. It was going to end up having a negative impact on the company. The whole focus of these bills, presumably, is that investment decisions by pension funds will be made solely on the economics and not any other outside concerns. So, I mean, we're keeping an eye on it, and I think for now that's all you can do.
Bob, just a quick question about the proxy voting. You know, I think that what we generally have done is allow investment managers to handle the proxy voting for us, and you know, we've given them sort of instructions to do it in the best interest of earning returns and what they think is, you know.
I think that'll continue to be okay, but you're going to need records of how they actually voted the proxies.
Okay.
And the reporting
Right.
is going to be. One in Texas, which I spoke to their pension review board, which is kind of like the equivalent of the Division of Retirement over there. And they're concerned about it because they would have to deal with literally millions of individual votes, and they don't, and the record keeping and creating a public database where people could look at it. You know, that's an overwhelming task, and I don't want us to get overwhelmed with a task that's going to end up with the, you know, costing you money. Well, actually, it will be an administrative expense that, as you know, is borne entirely by the city, even though the plan pays the initial costs. But we'll have to see if the managers are still willing to do that, if they have to do the kind of record keeping that some of these bills contemplate. So, you know, there are companies that sell proxy voting services. Some of them do have a, I won't call it a political bent, but they have an ideological bent, which may be one, you know, depending on one's view, might be wise and appropriate, and some people's view it might be the, you know, you're the spawn of Satan. So that's where the concern is going to be here. I'm sure the managers are aware of these issues because there are already 25 states that have adopted some form of House Bill 3. And ironically, the ERISA plans can continue to make decisions based on ESG principles, even if it does have an economic impact, because the Labor Department rule is still in effect. So for us, I think we're kind of in a wait and see.
Any other questions for Bob?
Thank you, Bob.
Thanks,
Safe
Bob.
travels, Bob.
Okay, good to talk to everybody.
Take care.
I had an interesting discussion with the BlackRock guy about this.
All right, Cole, the floor is yours.
They're divesting from it.
Excellent, thanks everyone. Pretty quick update today, walk through capital markets and performance, and then just a quick note on the IPS. So with that, yep, somebody right here. So showing capital market update, this is through January. Obviously a lot's happened since then, so I'll speak to that as well. But the 2023 year got off to a pretty good start. You can see up in the top left-hand corner, looking at those yellow bars, that's the 1 month return. So S&P 500 up a little over 6% in just the first month of the year, so pretty strong returns there. And you can see small cap stocks and international stocks did a little bit better than that. Over the last 3 months, international stocks have done really well, up 20%. Similar story on the fixed income side, on the right-hand side of the page, those yellow bars there, all positive returns for the year through January, as yields slightly decreased during January. Since then, yields have increased somewhat significantly. The 10-year at one point was trading above 4%, and now it's around about 3.5%. Just given all the disruption that we have seen with some regional banks going under receivership with the FDIC. And so obviously that's caused a little bit of volatility in the market, but for the large part has somewhat subsided since then. Markets are trading around the same level that they were prior to Silicon Valley Bank being placed into receivership. From an equity perspective, now, like I mentioned, from a fixed income perspective, we've seen yields pretty significantly come down across the 10, the 20, and 30-year parts of the curve. So a little bit of noise there, but right now, overall, the market's pricing in that this is not going to be a systemic issue. This is somewhat isolated, and the government's stepping in and maintaining those deposits, the various banks. So we'll see how that continues to unfold. The exposure to your portfolio was very de minimis. Just the only direct exposure was in various index funds, but equaling a few basis points total. So way less than 1%. So very, very de minimis exposure from a direct perspective, and from an indirect perspective, no material impact in either. The managers in your plan had very few, if any, relationships at all with any of those regional banks. So our operational due diligence team is continuing to kind of keep a close eye on things, but as it stands right now, not an issue. Year to date, so despite being up about 6% through January, markets are up around 2 to 3% right now. So February was a little bit negative, and March is fairly flat. So still in positive territory, but not quite off to the greatest start that we saw in January. Last thing I'd mention, the Federal Reserve is meeting today to decide whether or not to raise interest rates. Currently, there's about an 82% probability that they will raise interest rates 25 basis points, despite some of these cracks in the economy that are starting to emerge. So that's the expectation as it stands right now.
What time did they make their decision, Cole?
Either 2 or 2:30 this afternoon.
Thank you.
There were talks that they were going to raise about 50 basis points. I don't think that's on the table anymore. So they have somewhat, kind of tapered their view a little bit, but I still think they remain data dependent. So still pretty tight monetary policy. So looking at plan performance, as I mentioned, January is a pretty good month. So the month return of the plan was 5.3% total level, just a little bit underneath the policy index of 5.6%. So off to a good start, like I mentioned. Fiscal year to date, so since September of last year, the plan is up 13.2%. So always kind of keeping our eye on that fiscal year to date number. Off to a really good start as we're essentially a little over a quarter into the year of that fiscal year. So looking good there. All in all, the growth segment did well, returned 7.4% for the month, 9.4% for the last quarter. Largely aided by, on an absolute basis, was the returns from the international equity segment. So down there at the very bottom, Mower, even though a little bit behind their benchmark, they returned about 15% for the last quarter. Benchmark returned 20%, but still the 15% essentially doubled the return in the U.S. markets. So plan benefited from that. And then as it relates to the rest of the equity managers, LSV, Sustainable Growth Advisors, and Disciplined Growth Investors, all performing pretty well over the last month, 3 month in fiscal year to date. So really strong performance from the bulk of those managers. And then on the next page, just looking at the income segment, pretty flat returns for the fiscal year today, so since September and even this year, the last 3 months. So, throughout all the volatility over the last year, especially, you can see that, the plan benefited tremendously from the income segment, being positive 3%. Since then, just kind of maintaining positive numbers here. Keep in mind that some of these real estate managers down there at the bottom, are showing 0% returns. That's just because they give us data quarterly, so we don't have the data for that. So, but if you look over the last quarter, you can see, Harrison Street, the social infrastructure fund, up a little bit over 2%, with the market being down 5%. With the core property fund, it's essentially flat, with the market being down 5%, and then you can see Principal, who we just heard from, had a little bit of kind of some exposure to some write-downs there, but overall their long-term performance has been really strong.
Cole, would you attribute the Principal's core property fund performance relative to the Harrison Street core performance? Would you attribute that to write-downs, or is there some lagging in the reporting there between Harrison Street and Principal, or how would you describe that differential?
Yeah, it's good. It's a good question. So I would say that I think what's probably driving that the most part is just general diversification. So Principal has primarily, the exposure to those 4 main food groups, 2 of which being office and retail, which have faced a little bit tougher headwinds than industrial and residential. So despite kind of the way they have those portfolios positioned, there's just natural headwinds there. I mean, the office space, square foot leasing just isn't what it was, and so just having that exposure there has caused a little bit of impact on their returns. Whereas the 2 Harrison Street funds, they're more diversified. They don't play in those 4 main food groups, so they don't have to have exposure to office and retail, and so that's benefited them somewhat. But I mean, that being said, if you remember, Harrison Street still does have a decent exposure to nursing homes. Obviously that wasn't helpful during the pandemic, so it just kind of depends on the market environment that you're in and kind of what structural headwinds or tailwinds that you're facing. But as it stands right now, having to hold various office exposures isn't the most advantageous.
And it does look like there's at least a 1 or 2 month lag there in Harrison Street reporting compared to Principal.
Yeah, that's fair. Because Principal reports, I believe, monthly to us, and Harrison Street's quarterly. Right. So yeah, try to look at the longer term numbers there if possible to kind of see what's going on.
Thanks.
But that's why you have a very diversified real estate portfolio. You have exposure to all those various food groups and diversifiers, and throughout time, we believe that diversification will reward investors. So. But all in all, good results so far this year and fiscal year to date. So continue to keep close eye on anything, but everything appears to be in good shape.
Anybody have anything else for Cole?
You did want to mention the slight modification to the investment policy statement allocations.
Yep, so we reviewed the IPS last year, but then with the DGI amendment request, we wanted to go back and review the IPS again to make sure that it was in good shape. It does not actually contain any specific manager restrictions in it. Those are all held between the various managers and their investment management agreements. But with that, we just want to take a fresh look overall, and with the income segment, we just wanted to balance out credit and real assets. Here it was a little bit more weighted towards credit, and just balancing that out 50/50. So very small housekeeping item here, but just wanted to note that.
And I think the board will need to approve that change.
Any discussion? A motion to approve that?
Well, I'll move it, yes, based on the recommendation of our consultant.
Second.
Seconded by Harvey. All in favor?
Aye.
All right.
Thanks, Cole.
That is approved.
Thank you all. Let us know if there's any questions, but otherwise, we'll talk at the next meeting.
Thanks, Cole.
Bye.
Take care.
All right, next on the agenda is the reappointment of Harvey. And I don't know how we address this, what do we do?
Well, does he have a platform he's running on?
I think it's up to the board to
Are there any other
decide
candidates?
if they, are, well, we haven't advertised, so really.
I didn't ask that.
Right, we, it's up to the board. Harvey's volunteered to serve again. If the board wants to appoint him, they can, or if the board wants to instruct us to advertise, then we can do that. It's up
I
to-
move to appoint Mr. Lewis to
Okay,
a succeeding term.
all right.
And I'll second that.
All in favor of appointing Harvey again?
Aye.
Thank you.
You have to abstain. Well, although you know him pretty well and you like him, right?
Yeah, well, but I never had
Motion
voted on a drop plan.
passes.
Your alter ego.
Thanks for staying.
Yes.
All right, and then next is the RFP that was prepared.
Sure, so, we sent you guys a draft of an RFP, and I just titled it RFP because that's what the previous document we based it on was titled. We've spoken to the procurement division of the finance department, and, it's really up to the board. We had discussed doing an ITN to be able to bargain fees. I think we had some discussions with procurement, and they've done a couple of ITNs. Their ITNs were less about bargaining fees than about, I believe they referred to a waste management agreement where they wanted to bargain electric vehicles being used rather than diesel. So, there are different things you can bargain. With respect to the fees, doing an ITN and reserving the right to bargain fees is one way to do it. You could also include fees in an RFP as a criteria more heavily weighted to indicate to responders that fees are more important than, or have some importance. It's really up to the board. You can cut it up 6 different ways and call it different things, but you can get to the same place. So however the board wants to proceed, if you do want to sort of give tacit approval of the document that we sent, I would suggest do it with, as to form and content with minor changes that might be recommended going forward by the procurement department, because they have a handbook that we use, and the document I based this RFP on was actually a few years old, and the handbook's been updated, so I would actually go through and maybe update a few things in there. There are a couple of other issues the board should discuss, whether you want to do it now or at another meeting. It would be, once we send out the RFP and we get the proposals back, how do you want those proposals handled? Would you like the entire board to review all proposals and then determine which proposals you'd like to have people come in and present? Create a short list of those and bring people in to present.
Recording stopped.
Or would you like to have staff review the proposals and bring a short list to the board? Or would you like to create a subcommittee of a couple board members to review all the proposals? So you have a couple different ways you can do that.
Do we have any idea how many proposals we might get? I don't
When
even
we
know.
did it for, we did an RFP a few years ago for the general pension, I believe we got about 6 proposals. Since then, however, there's been even more consolidation in that industry. I would be surprised if we get more than 4 or 5 proposals, to be honest. But I could be wrong. I mean, we could get 10. I mean, I don't think we're going to get large companies. There are some large companies out there. But
Like Mercer, I don't think
yeah,
that's.
Mercer won't work with public pension clients.
Like working with
Yeah.
public. In general, looking at their pricing compared to other RFPs that I've been involved with
Yeah.
for their professional services.
And there are larger companies that are going to price themselves out of probably, you know. But, you know, there are regional firms, which is who I would expect to receive smaller, you know, they're still in the top 20 of the largest consulting firms by assets under management.
Recording in progress.
Consultation. But it's hard to say. And, you know, I mean, you could probably decide how you want to do it based on how many we receive. We could receive them in, come back to the board and say, we got this many, do you want to look at them all, or do you want us to sort of bring you a short list?
Man, I don't want to look at 10. I don't know about the rest of you. I've got a lot of stuff on my plate right now.
Dual office holder.
Yeah. Theoretically, it's not an office, it's because it's not a point.
Dual director.
So, we are putting at least some minimum qualifications that are going to weed out people that are trying to fish in a pond they've never fished in before.
We require them.
Asset size, that type of thing.
We require them to have experience with Florida pension plans of similar asset sizes, and also provide a list of that, and, you know, show their reporting and capabilities, and explain their relationships with State Street Bank and things like that.
Okay. Are you, I would prefer to have it kind of, gosh, I don't know, 5 are fine, 10 are not. I don't know what that sweet spot is for people.
How do you feel about waiting and seeing how many we get and then, you know,
Okay.
deciding then maybe?
Yeah, it would be May 12th would be the deadline for them. You know, May 12th, the May meeting, you'll know how many. But then was that,
So the idea would be.
goof up the rest of the timetable though?
I put a timetable, you know, a prospective timetable in the document, but that can be adjusted. But, you know, if the board agrees to, you know, informing content of what's here with some minor changes, we could get this RFP or ITN out, you know, next week probably, or the first week of April. And that would give them 6 weeks or so to reply. And these people have proposals ready to go.
Yeah.
It's a
That'll
boilerplate,
boilerplate.
you know.
What have you all, show me the weighting of how we're going to do that. I just want to, or what you all are proposing.
Yeah.
I'm not going to.
Because the motivation here was the.
And that's another thing I'd like the board to, you know, provide. And there's no
Absolutely.
rush. I mean, if you wanted to wait until the May meeting if you have recommendations that you want to make in the meantime, we can wait to hear from you all individually and make changes to this document, and then, you know, push the timeline back a couple of months so that the board can review it again in May. It's really,
And the only- I ended up with 2 questions about it. One of them I thought in section 2, provide similar services to other public plans. Does that exclude?
so it may be a separate document so that the weightings, the criteria weightings for evaluations, it might be in a separate document I didn't include. But I can send those out. And maybe it makes sense to wait and send those out so that you guys can comment on that stuff.
It's in the handbook.
Right. And I've got a separate document that shows the weightings of it. It's basically, if you look at the criteria for evaluation, it's based on those criteria and different weightings. But let me send that out to the board, and you guys can comment on that, and I can show you, how you can weight the fees, to sort of make sure they know that those are important.
They're important, but not so much that it's a lowest bid type thing. I want
Right.
to make sure that.
I mean, typically, you'll see fees range in weighting. If you want to lower the weighting, it can be 10%. If you want to increase the weighting, it can be up to 30 or more percent if you want it. So I'd recommend 25 or 30% fees, and that shows them it's substantial, but it's not enough to, it impacts the decision, but it's not enough to make
That's my
the sole
concern.
decision.
I don't want it to be at a weight that forces, move somebody to the top that we would otherwise not want. Everything else is no.
Right.
They meet the minimums, but.
So I'll take that, I'm sorry, I should have sent that document along with the RFP, but we'll send that out to everyone and maybe get individual feedback in the meantime and bring it back to the main meeting.
Okay.
And I have mentioned, I did put in here both standard traditional consulting services as well as the delegated investment or outsourced CIO arrangement. So we're gonna ask for both from the firms that can provide both. Not every firm will probably be able to provide both, but we'll ask for it.
And the fee differential, yeah.
Right.
Worth putting it out there.
But take a look at it, and when you have a chance, and if you have feedback, we'll send out the weighting criteria, the evaluation, and provide feedback on that too, and then we'll come back in May.
Yeah, come back in May before we make a decision.
Right.
Yes,
Yeah.
that's
Yeah.
correct.
All right, any public comment? No? Any other member comment? All right, the next meeting is in May, as we talked about. We can adjourn.